In today's global economy, China is a major player, the largest developing economy. How is China changing the world's economic landscape? Hello, I'm Anand Naidu in Washington, D.C., and this is The Heat. The second largest economy in the world, the biggest developing economy and largest in terms of purchasing power. And despite an economic slowdown, China is still growing at nearly 7% this year. The country's manufacturing-based economy is focusing on innovation to usher in the next phase of its growth. To tell us more about China's economy and its future, CCTV's Martina Fuchs joins us now from Beijing. And Martina, where does China stand in the global economy today, and what is the outlook for 2017?
Anand, as we near the end of 2016, China's economy is looking pretty good. Earlier this month, Chinese Premier Li Keqiang reassured the world that China will maintain steady growth and speed up its economic transformation. Data from the end of September indicated the world's second largest economy has stabilized and is still on target for 6.7% growth this year. This was mainly thanks to increased government spending and the mini property boom. So what are the main hurdles ahead? China is in the process of trying to rebalance its economy to adapt to slower growth, both at home and abroad. At the same time, policymakers are also wrestling with a wide range of domestic issues that could be disruptive, mainly the surging home prices and rising debt levels. Despite the slowdown, China continues to serve, though, as a stabilizer for the global economy. It remains the single largest contributor to world GDP growth. China is also taking steps to create sustainable economic growth with the Asian Infrastructure Investment Bank, the AIIB, which was launched last January, and the One Belt, One Road initiative. Like the ancient Silk Road, One Belt, One Road will create overland and maritime trade routes connecting China and the West. China's yuan, though, has also joined one of the world's most exclusive clubs for global currencies. This is important to say. The International Monetary Fund has added the yuan to a special basket of currencies that countries can receive as part of IMF loans.
Now, China is undergoing an economic slowdown. What kind of impact is that having?
Definitely. Based on the data from China released in October, the economy is on a much more stable footing now than at the start of the year. Data released over the past couple of weeks indicated continued stability but slower growth. Economic indicators ranging from exports to bank lending, along with expectations of a cooling in the red-hot property market, all suggest growth might flatten out in the coming months. There are also mounting fears of potential trade friction with the US when President-elect Donald Trump takes office in January. That's clouding the outlook a little bit. Top policymakers and investors are also growing more and more concerned about the risks of a debt-fueled stimulus. China's overall debt has jumped to more than 250% of GDP from 150% at the end of 2006. This is the type of surge that in other countries has resulted in a sharp economic downturn, as you know. Foreign governments have been urging China to take more measures to curb overcapacity in smokestack industries like steel or coal. China is doing that and much more. President Xi Jinping said he committed to supply-side transformation and really strengthening innovation. Back to you, Anand.
Thanks, Martina. That's CCTV's Martina Fuchs reporting from Beijing. Joining us now from Beijing, Zhou Hao is a professor and associate dean of the School of Finance at Tsinghua University. From New York.Eswar Prasad is a professor of economics at Cornell University and author of Gaining Currency, the Rise of the Renminbi. And with me in the studio, Yukon Huang is a senior associate in the Asia program at the Carnegie Endowment for International Peace. Thanks to all of you for joining us. Zhou Hao, let me start with you. China's economy is experiencing something of a slowdown right now, but it is on track to meet the government's target of 6.5 to 7% for this year. What do you make of that growth rate, and is it enough, in your view, to lay the foundation for sustained growth over the next few years?
Okay, there are clear signs that the economy is rebounding. We can see that the PPI are increasing from -6% to positive recently, and also there are other recovering, coal price, copper price, steel price, and also you have seen recently rising housing prices almost create a bubble. So all these signs putting together, there seem to be the economy has bottoming out. However, it still remains some dangerous area that could pose dangers to the economy. For example, one is a housing bubble, which has been under control recently. The other is exports. Exports is decreasing with the global trade. And the third thing is the private investment. In the contrary to the fiscal stimulus enacted by the government, the investment of the private enterprise is still dwindling. I think those areas are still worrisome and need to be watchful.
Eswar, from 2008 to 2014, China contributed something like 30% to world economic growth. Looking at the growth rate right now, what kind of impact will the current slowdown have on the world's economy?
Now, certainly China's growth does seem to have stabilized, as your previous guest pointed out. The good thing is that in China, domestic demand is doing quite well. The industrial sector does seem to have stabilized. The services sector is doing all right. Investment overall has done quite well during this upturn, even though private investment, again, as your previous guest mentioned, does not seem to be doing quite well. So the big question for the world economy is whether China is going to be able to maintain this growth rate in the range of 6.5% to 7% without a significant contribution from exports, because the reality is that the rest of the world simply isn't in position, except perhaps the United States, which is growing all right. The rest of the world cannot really absorb much Chinese exports. So domestic demand is the key issue. The problem is that if domestic demand comes largely from investment rather than from consumption, that could increase the dependence of China on exports in the future, even if it sets it off in the short run. But overall, the portents in the Chinese economy in terms of its rebalancing towards an economy that is more dependent on service sector growth, that is more dependent on consumption growth, those are all very positive signs. The big concern really is still about the midterm, the medium term, whether the risks being created in the system still with financial system imbalances continuing to rise, whether that's going to cause a problem for China and the world beyond the next couple of years.
Yukon Huang, what is your view? How does China adapt, retool, in order to make this rebound very real?
Well, as the previous guests have indicated, you cannot count on global demand, so you have to count on domestic demand. Essentially talking about whether it's going to be consumption and investment. In some ways, whether it's consumption and investment is not the choice or the issue. The question is which one makes sense and what does the economy really need at this moment in time? There are things the government is addressing that could help. For example, they have a new urbanization initiative. This is a country which is still only 56% urban. People projected to become about 65% over the next decade, which means that people are going to be moving to the cities. That means you're going to have to build more housing, more social services. That's a big concern. This is a country which is becoming more services oriented. A whole bunch of activities, investments, expenditures could be supportive of that. You have this big issue about the productivity of state enterprises and private enterprises. Private investment has been down, as the previous speakers have indicated. But can you liberalize investment in various protected areas so that there is, in fact, greater encouragement for private sector activity? If you do some of these things, then you can get the demand going. The demand may be consumption, the demand may be investment, but surely China needs to do something to make this more sustainable.
Zhou Hao, you mentioned some of the weaknesses that China is experiencing right now, the housing bubble, exports, as well as private investment. We talked about exports. What about the two other factors you mentioned, the housing bubble and private investment?
Okay, so the housing bubble has been mostly driven by the monetary policy. In the last few years, when the economy slowed down, the initial choice by the government is using the monetary policy, which is easy, quick, and reflected in the stock market bubble last year and housing bubble this year. However, the monetary policy can only cure the symptom, but cannot cure the cause of the slow economy. So going forward, we would expect is that the main stimulus will be shifting from the monetary to the fiscal policy. So if you remember, since last October, we haven't seen the central bank lowering the reserve requirement or the interest rate. But going forward, we know the government has enacted a huge stimulus package, including high-speed rail, infrastructure, and other urbanization projects nationally. So I think in the next 2 years, we will see more structural fiscal stimulus, but not too much monetary policy stimulus. And that would, form the basis we could judge that in the next few years, the economy probably will grow a little bit higher than the 6-7% we have observed this year.
Ezra, dozens of cities in China have taken steps to cool the property market, some requiring higher down payments. Some economists have warned, some businessmen have warned in China that it is spiraling out of control. What are the risks of a property bubble bursting?
I think the property price bubble and the private investment or lack of private investment issue that you mentioned come back to one fundamental problem that still bedevils the Chinese economy, which is that the financial system is not working very well. It's not working very well in terms of allocating the massive pool of domestic savings that there is in China into more productive investment opportunities. And what happens as a consequence is that you have financial system imbalances building up in one way or the other. Remember, just about 2 years ago, the big concern was about house prices falling too fast, and then stock prices rose too fast, and then fell too fast. And then there were concerns about the currency, the Renminbi. And now we are back to housing prices rising too fast again. So the reality is that unless you fix the financial system and get it working better, which is going to involve, fixing the incentives in the banking system, trying to get the banks to start behaving more like commercial enterprises, it's going to be very difficult to prevent these financial imbalances from coming up. And it certainly makes growth a lot more vulnerable if it's being boosted by these financial imbalances that pop up and then subside. If you want what Professor Huang mentioned, that is more productive opportunities in China being exploited well, productivity to be increased in the services sector and so on, you need to have more finance going to small and medium enterprises, to the services sector, and that's not happening. So fixing finance, I think, is crucial for dealing with these financial sector imbalances and also to make China's growth more sustainable.
Yukon Huang, as Ezra points out, there's a huge pool of private savings. Why isn't that used in a better way?
Well, China is a very unusual situation. In the midst of a slowdown, incomes have stayed relatively high. There's an enormous pool of savings. It's sloshing around. It goes to the equity market. It goes into housing. It goes overseas. It'll go everywhere it sees opportunities. Part of the reason that the housing market surged over the last year was that the government actually was discouraging funds from moving overseas, and therefore was looking for what to do domestically. And since the stock market is in the doldrums, they went into housing. So the question is, you have to increase the alternatives for these savers. So the equity market, for example, needs to be made more attractive. It needs to be made more representative of the whole productive structure of China so that people can buy stocks and more money can go in that area. Over time, China needs to liberalize its capital outflows. It's reasonable, in fact, that firms and people start investing more overseas, and they have been. But if you stop that flow, you also then encourage people to look for speculative activities domestically. So you have to have a system which is more open, more liberal, but you have to give consumers alternatives. Right now, they don't have all those alternatives.
Now, here's something that needs explaining. As you point out, as Ezra's pointed out, there's this huge pool of savings, but household debt is also rising.
Household debt has increased because a lot of it has been going into mortgages. Some of it actually is financing informal industrial activity, hidden as household debt. So household debt is maybe 40% of GDP. Now, it's increased dramatically, but it's not significantly larger than what's normal for other countries. Much of that mortgage financing is reflected in terms of very large down payments, so you don't see a risk. The issues in China tends to be corporate debt, which is 150% of GDP. Government debt is around 60% of GDP. So the real risks lie in the corporate sector. Where are they putting this money? Is it generating adequate return? The fact that mortgage and household debt has surged very recently, partly because of the housing market, is not so much of a concern given the nature of that mortgage financing in China.
Okay, we're going to have to take a break right now. Coming up, how does the addition of the Chinese currency, the renminbi, in the IMF special drawing rights basket change China's status in the global marketplace? Stay with us, you're watching The Heat.